One of the maddening things about the US tax system is that you and your neighbor might be living on the same exact amount of income in retirement, but they are paying far less in taxes than you. Why? Because they know how the US tax system works and they're using that knowledge to keep their taxes as low as possible so they can create more after-tax income and do more in their retirement. Now, believe it or not, paying less in taxes is actually one of the biggest things you can control in retirement. So in today's video, I'm going to share with you the 3 biggest tax mistakes I see retirees make so you can know this information, avoid it in your situation, and create more after-tax income to ultimately do more of what you want in your retirement years. And as we go through these, make sure you stay tuned through the end because the third mistake is likely one that you've heard of, but there's a twist to it that catches people off guard, and I want you to be aware of what that is. But the first mistake that I see people make is they are unaware of what's called tax gain harvesting. Now let me show you exactly what I mean by that. A lot of people are familiar with these tax rates right here. These tax rates for 2025 are the federal ordinary income tax rates, and it shows you what taxes you would pay at different levels of income. What people are often not aware of is these tax rates, or maybe they're aware of, generally speaking, that you pay 15% on average when it comes to capital gains. But take a look at this. There is actually a 0% tax rate where if your taxable income, and your taxable income is your adjusted gross income minus any deductions, if you are married filing jointly, and your taxable income is under $96,700, you pay 0% taxes at the federal level on any long-term capital gains and qualified dividends. If you are single and your taxable income is under $48,350, you too are in that 0% federal long-term gain tax bracket. Let me show you an example of how you can use this information to save a ton of money in taxes in your retirement years. So for this example, let's look at someone who is 62 years old, single, and wants to live on $75,000 per year in retirement. Now this individual has a traditional IRA, they have a Roth IRA, and they have a fairly sizable brokerage account. Now the actual amount doesn't matter, but let's just assume $1 million for a nice simple round number. And of that $1 million, let's assume that this individual initially put $250,000 into this account, and the rest is unrealized gains. So $250,000 they put in, $750,000 of unrealized gains. Let's take a look at a tax analysis to see how they can use this information, use this tax gain harvesting information to pay nothing in taxes this year. So we're going to call this individual Joe Sample. Here's Joe Sample, and as I mentioned, he has an IRA, a Roth IRA, and a brokerage account. And to start, Joe is going to take $15,000 from his IRA. He is going to do that because if I click on tax report here, what we're going to see is this report right here for Joe. Here's the $15,000 he's pulling out of his IRA. That is completely offset by the standard deduction that Joe is taking, $15,000. Now, by the way, if you are married filing jointly looking at this, the standard deduction is exactly double. So don't use $15,000, use $30,000, but you can kind of get the picture whether you're single or married filing jointly as we go through this. So this is $15,000, and so far what we can see is Joe is paying nothing in taxes. Total tax $0 because his total income of $15,000 is completely offset by the standard deduction. But Joe's only received $15,000 of income so far. He wants $75,000 of income to be able to do what he wants to do in retirement. Now let's go back to this chart that I just showed you, looking at long-term capital gains rates. Remember, Joe is single, and so if he can keep his taxable income under $48,350, he's not paying any taxes on that. Now this is what that does not mean. This does not mean that Joe goes to his brokerage account and sells $48,350. $48,350 is the gain that we're looking for. And keep in mind that any dollar, or for every dollar that Joe sells, 25 cents of that is just a return of his own capital. 75 cents of it is the gain. So for Joe, we know he needs $60,000 more dollars. If he wants $75,000 total, 15 is coming from his IRA, 60,000 is the remaining amount that you like. Now, if he sells $60,000 from his brokerage account, what that means is $15,000 is his cost basis coming back to him. $45,000 is a long-term capital gain. That $45,000 less than this. So let's go back to this analysis here and plug that number in. Let's assume here that Joe is going to realize that, and that means that he will have $45,000 of long-term capital gains. What does that do? So if we plug this in and we generate another tax report for Joe, here's what that's going to look like. Let's scroll down here. Joe now has $60,000 of total income. This total income or adjusted gross income is $15,000 from his traditional IRA plus $45,000 of long-term capital gains. He only has the $15,000 deduction now, so he has taxable income of $45,000, but he still has a total tax of $0. Why is that? Well, why that is of this $60,000, $15,000 was from his IRA. That is an ordinary income amount. That was completely deducted out or washed out by the standard deduction. This remaining $45,000 is not taxed at ordinary income rates. If it was taxed at ordinary income rates, it would start filling up some of these tax brackets. But you see, he has $0 of ordinary income and 0 taxes on that. Where that $45,000 of income is showing up is it's showing up on his long-term capital gains tax rate. And again, because that's under $48,350, he is generating income, but he's paying $0 in taxes to do it. So what Joe has effectively done here is generated $75,000 of income. But because he was smart about how much did he pull from his IRA versus how much did he pull from long-term capital gains, he is in a 0% tax bracket. Now, in real life, the goal is not always to be in a 0% tax bracket every single year. The goal is to minimize your lifetime tax liability, but I wanted to illustrate the power of understanding the 0% bracket for long-term capital gains to really keep your income low in retirement. This concept is often called tax gain harvesting, not to be confused with tax loss harvesting, which is when you're intentionally locking in losses. This is when you're intentionally locking in gains, but doing so under the 0% long-term gain threshold. Now, depending on what state you're in, you may still have state income taxes, but I'm just looking at the federal tax brackets here. And also, as Social Security starts to kick in, as other income sources start to kick in, this gets a little bit more nuanced and a little bit more complex than just looking at one IRA distribution and one long-term capital gain realization, but I want to illustrate the principle here because that's the first mistake that I see too many retirees make. The second mistake I see far too many retirees making is falling trapped to what's called the Social Security tax torpedo. To fully understand what the Social Security tax torpedo is, you have to understand a concept called provisional income. Here's a chart that shows you these provisional income numbers right here. And if you're single, if your provisional income is under $25,000, none of your Social Security benefit is taxable. You can see between $25,000 and $34,000, up to 50% is taxable, and amounts over $34,000, 85% of your Social Security benefit is taxable. You can see how that compares to married filing jointly and how those numbers are slightly different. If you want to know more about how provisional income is actually calculated, I will link to a video at the end showing you exactly how that works. But what you need to know for the sake of this projection or this example is half of your Social Security benefit is included in your provisional income. So if your Social Security benefit is $30,000, $15,000 is included in your provisional income. If it's $50,000 between you and a spouse, $25,000 of that is included in provisional income calculations. So let's look at an example to show you how this concept leads to what's called the Social Security tax torpedo, which increases, almost doubles actually, your actual effective tax rate on each additional dollar earned between certain thresholds. So here we are again with a tax projection for Joe's sample. This time we're going to assume that he's married filing jointly. If you remember from before, if his and his spouse's provisional income is under $32,000, none of their Social Security benefits are taxable. So let's take a look at this. Let's assume that Joe and his spouse have $50,000 of combined Social Security, and they have $6,000 from an IRA distribution. Total income is $56,000, but provisional income is $31,000. Provisional income is half of this, so $25,000, plus this IRA distribution of $6,000. So $31,000 combined, which means, if we run a tax report here, none of Joe and his spouse's Social Security is taxable. $50,000 of benefits, but zero of that is actually taxable. So if we look at their adjusted gross income this year, their adjusted gross income is only $6,000. And that $6,000 is from the IRA distribution because none of the Social Security benefit was taxable. So $56,000 of actual income, $6,000 of adjusted gross income, and the entirety of that adjusted gross income is offset by the standard deduction. The standard deduction is actually $30,000, but any taxpayer who's 65 years old or older gets an additional $1,600 added to the standard deduction. That's the reason for this $31,006. This isn't the point though. The point though is this aspect right here, and I want to show you how this changes. Because a lot of people look at this and they say, well, that's fantastic. I've got a lot of room to go before I actually start using up the entirety of my standard deduction. So what if hypothetically we turn this $6,000 into $40,000? What you might think at first glance is, okay, you would have $40,000 of adjusted gross income, you would have a deduction, but then you'd end up paying taxes, or you'd end up having $8,400 of taxable income once you factored this in. That's not the case though. Let's go back here. What we've done is we said the same thing, same $50,000 of gross Social Security, but now we're comparing that to $40,000 of an IRA distribution. If we run a tax report on that scenario, what you're going to see here is all of a sudden the total income isn't $40,000, it's $63,850. Why is that? Well, the reason for that is now their provisional income is a lot different. The provisional income in this case would be $40,000 of IRA distributions plus half of the Social Security, so $65,000. So part of their Social Security benefit is now being pulled into their taxable income, and you can see here's their total Social Security benefit, and now $23,850 is taxable. So let's take a look at some specifics here, and then I'm going to show you that trap that I talked about, the Social Security tax torpedo that we're going to use this example to illustrate. So here's their new adjusted gross income, $63,850, deductions, their actual taxable income, $32,250. We can look at that. Some of that money is taxed at 10%, so some of that taxable income is taxed at 10% marginal rate, some is taxed at the 12% marginal rate, and you can see what that looks like here. The first $23,850, they pay a 10% tax on, so their total tax is $2,385, 10% of this. Now, once they've exceeded this threshold, the next $8,400 of income they have is taxed at 12%. That's the tax rate of $1,008. So take a look at this number, and this is the number I want you to keep in mind, a total tax of $3,393. If I now go back here, go back to their tax page to start playing with some of these numbers, what if we convert an additional $100 here? Because going back to his tax report, I would look at this and say, great, they're in the 12% bracket. The 12% bracket tends to be a great place to do Roth conversions. Not always, but it's often a good idea to at least consider a Roth conversion here. Say, can we pay taxes at a 12% rate today to avoid paying them at a higher rate in the future? And they have a lot of room here to convert within the 12% bracket, or so they think. Let's go back. Let's go back here and say, what if instead of a $40,000 IRA distribution, they take that $40,000, but then say do $100 of a Roth conversion, or they just take another $100 out of their IRA. All is still equal with their Social Security, so still taking $50,000, but a tax report here shows us the point I want to illustrate. If we now look at their total tax, $3,415, compare that to what it was before, $3,393. 22 extra dollars to federal taxes, but they're in the 12% tax bracket. How on earth could that be? You would think that every $100 of extra income they pulled out would be subject to $12 at the federal level. You would think that, and you're right, and that they are in the 12% marginal tax bracket, but this is the concept of the Social Security tax torpedo. As they are pulling more out of their IRA, those dollars are taxed at 12%, but every dollar they pull out is also pulling in 85 cents of their Social Security benefit that was previously untaxed into their taxable income. So yes, each dollar or each $100 is taxed at 12%, $12 here, but also that Social Security benefit is now increasingly more taxed. So the actual effect here is instead of each additional dollar between this range being taxed at 12%, each additional dollar pulled is leading to a little bit more than $22 in extra taxes owed, meaning there's an effective tax rate of a little bit more than 22% when you think you're actually in the 12% tax bracket. Now, there are still some cases where it makes sense to do those Roth conversions, or it makes sense to take more money out of your IRA because that 22% is still lower than where you expect to be in the future. But be hyper cautious, hyper aware here, because I see far too many people thinking that the impact of a Roth conversion in this window, the impact of more IRA distributions in this window, is just that 12% marginal bracket. But they're not quite seeing the whole picture. It is a 12% tax on that dollar, but it's also simultaneously pulling in more of your Social Security benefit to be included in your taxable income, and then that's leading to an even higher tax rate. Okay, now the third mistake I see retirees make far too often is converting the wrong amounts to their Roth. Now, what most people think when they hear this is they think, yeah, people don't know about Roth conversions. And if they don't know about Roth conversions, they're leaving lots of money on the table by not converting. That is true, but so too is the alternative. I see way too many people who are overly eager, overly ambitious, and converting too much from their IRAs to their Roth IRAs, and they end up paying way more in taxes than they otherwise would have had they simply left things alone. So what I want to do is show you the impact both of over-converting and under-converting so that you know what that sweet spot is for you. To do this, we're going to take a look at John and Sally's plan. So John and Sally don't actually pay too much attention to the numbers here. I'm going to show you what this looks like if these numbers are radically different, but they have a sizable IRA. $2.5 million in their IRA, $750,000 in a joint account. I want to show you the impact, what they would lose out on if they never did any Roth conversions. So what this page is showing here in this tax strategy section is this is showing what their taxable income would be if they never did any conversions. In this scenario, they are living on their taxable account, keeping their income super low for the first several years of retirement, But then required distributions start at age 75, and all of a sudden they're forced to distribute a big chunk of their IRA. And what you can see is we've overlaid various tax brackets, meaning we're not just looking at what is their taxable income before doing any conversions. That's what this purple shows. But we're comparing that to where's a 10% bracket, where's a 12% bracket, where's a 22%, 24% bracket. And what you can see is they're actually projected to be in a far higher tax bracket in their later years than they are in their initial years when they're just living on their brokerage account and Social Security. So when you see something like this is a perfect use case to say, can we do some Roth conversions? Maybe up to the 10% bracket, maybe up to the 12% bracket to fill in some of these gaps here, where you can pay a relatively small amount in taxes to avoid paying far more in taxes in the future. To illustrate that, what would this look like if any year they were under the 12% bracket at the federal level? What if they converted enough from their IRA to fill up that 12% bracket? Well, as you can see here, that's a pretty dramatic impact, almost a 7-figure impact in the tax-adjusted ending wealth that they would have when they took this opportunity to say, we're not just going to sit around and wait for our IRA to continue growing and generate significant distributions in the future. We're going to intentionally pay more money in taxes up front at a lower rate today to avoid paying a much higher rate in the future. So this is an example of one mistake, people just being unaware that these type of opportunities exist, and hundreds of thousands of dollars of value simply evaporate because they don't take advantage of them. But here's the flip side of that. One reason this made so much sense for Joe and Sally to pursue is they had a significant IRA balance. And not just a significant IRA balance going into retirement, but a growing IRA balance throughout their retirement that led to pretty significant required distributions that pushed them into much higher tax brackets than they wanted to be in. So now let's go back to Joe and Sally's initial balance sheet and just looking at some of the assets they have. What if instead of having $2.5 million in their portfolio or in their traditional IRA, it was a tenth of that? They had $250,000. So now they have $1 million going into retirement, some in a traditional IRA and the rest in a joint account. So all else is equal. What changes is their tax strategy. So here's that same exact page we looked at before. But if you recall before, this purple part of the graph, their taxable income before doing any conversions, it was exceeding the 24% or 28% tax bracket later on in retirement because of the impact of required distributions. It was going to push them into a much higher tax bracket. Now that's not the case. That's not the case because they're not going to have as significant of an IRA balance, which means the required distributions are still going to exist, but because those required distributions are a percentage of the overall balance, a lower balance means lower required distributions. So if in this instance they were to do the exact same thing we looked at before, simply thinking, oh, well, we saw this YouTube video, it said convert up to 12% bracket, we're going to do exactly that. Well, in this case, if they were to do that, now they're actually losing 6 figures of wealth by doing that. They are converting at a higher rate today than they otherwise would have paid had they simply done nothing. So what you can see here is there's a very fine line between, yes, Roth conversions can be insanely beneficial, but I see some people who fail to take advantage of them and they lose out on the wealth. I see other people who convert too high of an amount. And by converting too high of an amount, it's actually detracting from their overall tax picture and detracting from what their portfolio could have been. These are 3 tax mistakes I see, but there are so many things, so many tips I want to give to you all to make sure that you are creating a more secure retirement. Make sure you subscribe so you never miss an episode. But as you start to see this, these are 3 very common things. Not understanding that there's a 0% tax bracket to realize long-term capital gains. Not realizing the impact of the Social Security tax torpedo because of something called provisional income. And finally, not realizing that yes, it is possible to lose out on money because you don't do any Roth conversions, but it's also possible to lose because you do too many Roth conversions. Now, one big thing that I mentioned was the impact of provisional income. If you want to understand more about that, check out this video I made here, where I talk about how Social Security is calculated and walk you through some examples so you can see what that might look like for you. Root Financial has not provided any compensation for and has not influenced the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been invited, have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.